Hi, it's Paul Meredith, mortgage broker with the Paul Meredith team at CityCan Financial and author of the Amazon #1 best-selling book, Beat the Bank: How to Win the Mortgage Game in Canada. Today we're going to be talking about what's the difference between renewing, switching, refinancing, porting, all these different terms. Mortgage terminology can sometimes get a little confusing, and sometimes if you don't have the terms right, it could lead to you getting incorrect mortgage information from your mortgage professional. So what exactly do all these terms mean? Well, a mortgage renewal is simply that you're renewing your mortgage, which implies you're renewing it with your current lender. If you're going to move to a different lender, that is no longer a renewal. That is then called a switch or a transfer. Now, when you're renewing your mortgage, when your mortgage comes up for renewal or maturity, and maturity date is your renewal date, your current lender will generally reach out to you with some options. Now, sometimes they'll reach out to you a few months before, sometimes it's a month before, but you can generally start looking into your options about 120 days before that renewal date. And that's how long the maximum rate hold is 120 days. Now, the worst mistake you could possibly make here is signing that form, picking a rate, signing that form, and sending it back to your lender without first checking into other options to find out if those rates are actually any good. Sometimes lenders will charge a higher rate when it comes up for renewal. Other times they might be super competitive on that and they may be offering you the best rate out there, but you can't make that assumption. I've seen banks try to renew people into their posted rates, which are significantly higher than their discounted rates, which is what any new customer would get if they were to walk into that bank. So you have to be very careful here because banks know this. They know that a lot of people will just send that form and send it back to them. It's quick, it's easy, it's the path of least resistance. We all lead busy lives. We're all looking for something that's quick and simple, and signing that form and sending it back to the bank, it could not get any easier than that. But this can be a very costly mistake. So that's where you need to look into other options to find out if they are going to give you a competitive rate or not. Now, to transfer to a different lender, if you're moving your mortgage to a different lender, and often we can save you thousands when your mortgage comes up for renewal over and above what your current lender is offering you. So even though the rate they're offering you might look okay, there might be something a lot better out there. Different lenders come out with different promos at different times, and when your mortgage comes up for renewal, there is a lot of opportunity to save money there. So we would give you then the lowest rate for your available for your situation at that time. Now, usually when you're doing a mortgage transfer, or also called a switch, usually the legal fees are covered for you. Now, there is a discharge fee from your current lender, which is usually around $300, but can go up to $400. It's usually between that $300 and $400 mark. And there's also a small government fee of roughly around $80. Government always has to get their little piece in there somewhere. So there's also that government fee in there as well. Now, when you're transferring a mortgage, as I mentioned, the legal fee will apply. The discharge fee and that small government fee would generally get added to the new mortgage. Now, there are some lenders that will cover the discharge fee for you, but these are few and far between. Most of them will add it to the new mortgage balance, to the new mortgage that you're transferring. So there shouldn't be any cost out of pocket either way. Now, when you're doing a mortgage transfer, it's basically a continuation of where your mortgage left off. It's just like when you're renewing your mortgage, you're not extending your amortization, you're not increasing the mortgage amount, you are just renewing the existing mortgage. The same applies with a switch and transfer. So you're just switching over that existing mortgage. So the existing mortgage balance, the remaining amortization, that will transfer over to the new lender. Now the maximum amortization is based on years passed on the calendar. So let's say, for example, you had a 25-year amortization to start, 5 years has passed, 20 years is remaining, your maximum amortization is going to be 20 years. Now, sometimes your amortization might show lower if you're making accelerated biweekly payments, if you took advantage of your prepayment privileges, made lump sum payments, made additional increases to payments, then your effective amortization might be lower. You might have started with 25 years, maybe 5 years has passed, but you might have 17 years or 16 years or 15 years or something like that actually remaining on your mortgage. You can increase it back up to that 20. Now, there are some situations where you can go back up to the original amount. There are some, in most situations, you can't, just based on years passed on the calendar. Now, you can always go lower on the amortization, but you cannot go higher. Now, usually what I'll recommend, as long as there's no change in rate, and I'm kind of going off topic here a little bit, but I will recommend going with the longest amortization possible, and then you can always use your prepayment privileges to bring that amortization back down. For example, let's say you have, you can go as high as 20 years, but you want to go with a 15 to get that mortgage paid off quicker. All you need to do is use your prepayment privileges to set your payment to match that of a 15-year amortization, and you will have something that is 100% identical to having a 15-year amortization. The benefit to you is you can always revert back to that lower payment at any time during the term. So let's say, for example, you need to increase your cash flow for whatever reason. Maybe you're going on maternity leave, or your wife's going on maternity leave, and you're going to have a lower cash flow. You can then take advantage of that lower payment at that time, and then increase it back again when the income is restored. Another time that can be helpful is if you're looking at buying an investment property. By going with the higher amortization, you're going to have a lower minimum payment that you can revert back to, and that will allow you to qualify for a higher amount. Again, I digress, back to the topic. So if you do want to increase your amortization back up to 30 years, or if you want to increase your mortgage amount, then that would be considered a refinance. So refinance can sometimes carry a higher rate, not always, but very often there is a higher rate associated with a refinance. So you could potentially be looking at a higher rate, but that allows you then to get the extra money you need, and it allows you to bring your amortization back up to 30 years, which a lot of people are looking at doing these days, because with rates being so much higher, people are renewing out of much lower rates into much higher rates. And so a lot of these people, they want to bring that payment down. They want that payment as low as possible. So even though the rate might be a little bit higher, you will get a lower payment by increasing your amortization up to 30 years. So many people look at, many people are looking into that as an option. And the cost associated with a refinance, there is generally a legal fee of roughly $800. In many cases, there's an appraisal fee, which usually runs around $400. In some cases, the appraisal can be covered or reimbursed for you. We will advise you on that, on your options, when we discuss your situation with you. So another possibility is porting, and that's another term that people sometimes get wrong too, because they say they want to transfer their mortgage when really they're looking at porting it. And porting is where you're essentially transferring your mortgage to not to another lender, but to a different property. So let's say you sell your current property and you've purchased another one. You want to take the rate that you have on your previous mortgage and transfer it over to that new property. That can generally be done. Now, there are some circumstances where it can't be done, where it's not possible, but very often it can be. So you can preserve that lower rate. You will not pay a penalty to break that mortgage in that case, and then you would then port that mortgage over to the other property. If you need additional funds, which is usually the case, the additional funds would then be added at whatever the rate is at that time. So let's say you have 2.49, you have 2 years remaining on that. and you owe $300,000, that 2.49 would remain intact until the end of that original term. Let's say you need to borrow an additional $300,000 or $400,000. That money would then get added at the current rate. The two are then blended together for a single rate and payment, and that is what's known as a blended mortgage. So we've talked about the difference between renewing, between switching or transferring your mortgage, between a refinance and porting. So 4 different terms that people often get wrong or misuse. Now, when you use the wrong terminology, a seasoned broker will be able to ask you questions. They'll be able to figure out exactly what you're looking for and be able to guide you in the right direction. Some mortgage specialists who may not be quite as experienced, they may just take your question at face value and answer it, which could lead to incorrect information. It could lead to a wrong, incorrect rate. It could lead to an incorrect quote of costs, and it could end up, you could end up with an approval for a mortgage that you don't need. You might be looking for something completely different. So like I said, someone who's seasoned will be able to determine that. So this video and my blog from yesterday, which was on the same subject, will teach you a little bit more about the terms. And as I say in my book, an educated borrower is a smart borrower, and that can be the worst nightmare of an inexperienced mortgage professional. So, and professional in quotes in that case. So that's about it for today. If anybody has any questions, you can always shoot us an email at pmteam@citycan.com. Check out our website at www.easy123mortgage.ca. Now, I do these Instagram live videos every Thursday at 12 noon. It's always on the topic of my blog that I release on Wednesday. So you can check that out at easy123mortgage.ca/blog. And hope to see everybody here again next week at the same time. Have a great day, everybody. We will see you then. Until next time.